Coming off November CPI data, I want to talk food inflation, which is impacting some of the biggest restaurant chains in the U.S. Danilo Gargiulo is here, a senior research analyst at Bernstein. I want to start with Starbucks. Price of coffee, which broke a 47-year-old record just yesterday. Where are we really, if we were to look historically at what the cost really is?
Yeah. Look, the cost for coffee clearly has spiked over the past few months. This is not something new. This is not something that really happened over the past month. It's something that evolved this year. And part of that is because of the supply constraints that we are seeing specifically in South America. So there is some production constraints that are really affecting, and obviously some macro factors and weather factors that are affecting the amount of coffee being produced right now, which is affecting the cost of the coffee beans. And so this is affecting both the Robusta as well as the Arabica. I would say the Robusta beans, which are typically the lower quality beans, have seen the kind of biggest spike in terms of cost. And Starbucks, since you were asking about Starbucks only offers Arabica beans, so it should be relatively less affected by these price increases, even though, coffee still constitutes about, kind of low 20% of the food basket for Starbucks.
But is your sense, a bit more broadly, what's happening here? By the way, we're having a big debate in this country about whether, Kroger and Albertsons should be allowed to merge and whether that would be inflationary or not. Is it about that, or is just food prices have just gone through the roof?
Well, that's an excellent question. Look, the food prices, especially for the restaurant sector, have been really skyrocketing. Maybe during 2022, early part of 2023, there was an expectation that consumers were able to essentially absorb some of the price increases that either the franchisees or the local restaurants were charging to consumers to protect their margins out of commodity costs really increasing, especially, and also labor costs increasing. So to protect their P&L, they passed on some of the costs back to the consumers. At the beginning, this was working out. Consumers were able to essentially use some of the savings accumulated during the COVID era to continue to go to restaurants. And then all in a sudden, we've seen some big pullback among consumers. And this really spiked at the beginning of this year, and really kind of the bottom in terms of foot traffic for restaurants was in July, when you saw a big delta between food at home inflation versus food at home versus food away from home inflation. And just to give you a couple of numbers, the food away from home inflation used to be about 5.1% in January versus the food at home inflation at 1.2%. And now with the latest data, we see that the food at home inflation is 1.6%, so going a little bit up, whereas the restaurant inflation has gone a little bit down to 3.6%. So when these dynamics are changing, when you have the relative inflation of grocery the decreasing versus increasing versus the restaurant inflation, that's when you start to see more people going to restaurants.